A shocking new appointment at the Federal Reserve just sent markets into a tailspin, revealing a seismic shift in the future of our economy that few saw coming. It's official. If you have any money in the markets whatsoever, you'll want to hear what just happened. In a surprising turn of events, Trump confirmed that Jerome Powell will soon be replaced as the head of the Federal Reserve. The person he appointed was not who the markets were expecting. Immediately after the announcement, stocks began selling off. Gold and silver experienced their biggest drop in history. The era of easy money now appears to be completely disappearing, as Trump's new leadership has fundamentally changed the rules of the game overnight. We need to explore what precisely occurred, why nearly everything began to sell off, how you can best protect yourself as an investor, and most importantly, how to leverage this new information to make money. Because believe it or not, moments of chaos often present the best opportunities, but only if you know where to look. All of this begins with the new head of the Federal Reserve, Kevin Warsh, not Jim Cramer, as some might jokingly suggest. Kevin Warsh served as a Fed governor from 2006 to 2011, a period encompassing the Great Financial Crisis. During this time, the Fed was orchestrating government bailouts, establishing market backstops, and essentially striving to prevent the entire financial system from collapsing. However, critics note that back in 2008, Kevin Warsh was concerned that stimulus measures would be excessive. He advocated for keeping interest rates higher for longer and, in 2010, warned about the risk of runaway inflation, even though inflation remained historically low for the subsequent decade. In 2011, despite Warsh's assertion that stimulus wasn't needed, the Federal Reserve announced an additional $600 billion injection into the economy to aid the housing market. Kevin Warsh was a fierce opponent of this, calling the benefits small and fleeting, and the risks potentially large. However, once he realized he couldn't stop the flow of money in 2011, he resigned, thereby cementing his reputation as someone who would rather see falling prices and slower growth than risk devaluing our currency. Even in 2022, Kevin Warsh stated that the Fed waited too long to raise interest rates. He claimed the Fed lost credibility by overstimulating post-COVID, believed quantitative easing inflated asset bubbles and worsened inequality, and desired a smaller balance sheet with a greater focus on stability. In essence, Kevin Warsh's entire economic philosophy centers on higher interest rates, slower growth, and a stronger dollar, which is the exact opposite of what markets were expecting to see in the coming years, leading to a rather dramatic sell-off. So, what happened? To be honest, all of this has to do with what's called the Trump effect. As of today, markets are grappling with significant uncertainty. For the last year, Trump has repeatedly promised lower interest rates. He has openly criticized Jerome Powell for not cutting interest rates faster and more aggressively. Most investors operated under the assumption that quantitative easing would continue indefinitely, potentially leading to extreme inflation where a Big Mac might cost $100. But now, Kevin Warsh is expected to come in and potentially cool the economy to save the US dollar, print significantly less money, reduce the Fed's balance sheet, and prevent the United States from becoming another statistic in Ray Dalio's New World Order. In fact, just a month before the presidential election, Kevin Warsh was asked what he would do if he became the chair of the Federal Reserve. He responded that policies beneficial to asset holders are detrimental to those living paycheck to paycheck, and that we are essentially enriching stockholders at the expense of everyday Americans. When asked if the stock market would have to fall, he replied, "If the central bank were forced to focus on the real economy, the financial markets will take care of itself," implying that yes, markets would fall, but long-term it would be for the greater good of society, as the rich wouldn't just keep getting richer. Now, even though this seems like a complete reversal from everything Trump has promised over the last year, The reality is that the Kevin Warsh of today is quite different from the Kevin Warsh we saw a few years ago. For instance, Warsh is now advocating for lower rates to stimulate growth. He recently stated that we could significantly lower interest rates, making 3 0-year fixed-rate mortgages affordable and revitalizing the housing market. He sees himself as an ally to the White House in the coming term. Of course, others claim that he has completely flipped his stance and has become a mere puppet to secure the position. But regardless of what ends up happening, the market has spoken. Kevin Warsh's history suggests that there will be no dollar collapse. If the dollar gets stronger, the stock market will likely get weaker, and with tighter conditions, we could actually start seeing mortgage rates go higher. So, what does this mean for the economy moving forward? Well, it really depends on who you ask. For Trump, believe it or not, he actually wants the dollar to lose purchasing power. And even though it sounds completely counterintuitive, to a certain degree, it actually makes sense. Think of it this way. When our dollar is strong, other countries need to pay more to buy American goods, making our products less competitive. Also, when our money buys more overseas, it encourages people to shop outside the country. However, when our dollar becomes weak, it encourages other countries to buy from the United States because our products appear cheaper. It pushes stock prices higher, and it makes the government's massive debt easier to deal with over time. All of this suggests that we're about to enter an environment that is completely different from what investors have been conditioned to over the last decade. Whether Kevin Warsh ultimately lowers interest rates is largely beside the point. What truly matters is that the era of predictable bailouts, constant liquidity, and perpetually rising asset prices is being fundamentally questioned for the first time in years. So, regarding whether Kevin Warsh is expected to follow Trump's directives, lower interest rates, and do what he's told, or go rogue and keep interest rates higher for longer, we need to discuss exactly what happens to markets during times like this, what is most likely to happen next, and crucially, how you can leverage this information to make money. Because, believe it or not, times like this create some of the most unique opportunities to come out ahead if you know where to look. Now, in terms of what's expected to happen next, and how you could use these next few months as a massive advantage, it's crucial that you understand the stock market. Markets typically do not fall or react solely due to a single event. Instead, they reprice based on broader expectations for the future. And the one thing the market hates more than anything else is uncertainty. When markets can't reasonably predict the future, they fall to compensate investors for the increased risk. And that's exactly what's beginning to happen. A new Fed chair nomination like Kevin Warsh is precisely the kind of event that creates uncertainty. He has previously been the opposite of what markets have been accustomed to, and it's too early to tell whether he will simply listen to Trump. On top of that, it's also important to clarify that when something does happen, the market typically overshoots way too far in one direction before it eventually swings back much further than most people expect. For example, in April 2025, the sell-off was far more dramatic than it should have been, just as Trump's "good time to buy" tweet caused a much greater frenzy to get back into the market. But let's normalize things for a moment. Every single year, without fail, the stock market drops. Take a look at this. Even in years where the market finished higher, we saw 10% to sometimes 20% declines. In addition to that, Charlie Munger famously said that if you can't handle these types of swings, you deserve the mediocre results you're going to get. To take this a step further, since 1980, the average S&P 500 intra-year drawdown is 1%. And in 34 of those 45 years, the S&P 500 has finished with positive returns. Separate from that, Actually closing the year down is surprisingly uncommon throughout history. If you go all the way back to 1950, you can see that only 2 years concluded with a decline exceeding 25%, and only 3 years saw a decline between 15% and 25%. The remaining years either saw minimal losses or, more commonly, generated significant returns. Plus, if you want to feel better about investing during a time like this, the average time to recovery from a 5% to 10% drawdown is 3 months, and the average time to recovery from a 10% to 20% correction is 8 months. But fine, let's say things get really bad. We end up seeing a market drop at the same time as a recession, and things become truly severe. Even in that scenario, the stock market recovered on average within 1 to 2 years. Because of that, investors are much better off just adding to their portfolio and holding than selling and trying to buy back cheaper. And if that doesn't sound crazy enough, here's one more piece of data that will just solidify it. Historically, when January sees a gain between 0% and 2%, the subsequent 11 months have been lower only once. Typically, a positive January indicates the rest of the year will average 9% higher returns. It's also not unusual for February to be one of the worst months of the year for stocks, averaging negative returns since the 1950s. That's why, in terms of the best way to make money going forward, we need to talk about the long-term strategy. Studies show that despite market volatility, risks, and uncertainty, you have a 62% chance of being positive after a month, a 75% chance of being profitable after a year, 89% after 5 years, 95% after 10 years, and 99.8% after 15 years. Put another way, if I told you you have a 99.8% chance of making money 15 years from now by investing everything you have into the markets today, would you proceed? If the answer to that is yes, well, that's a pretty good reason to keep investing your money, even if the short term seems shaky or even goes down in price. My point is this. The tried and true method for investing in stocks, which has proven effective throughout history, is simply a consistent buy and hold strategy maintained for 20 to 30 years. That's it. Seriously, the stock market and cryptocurrency are among the few markets where a price drop causes widespread panic. From my perspective, unless you're planning to cash out and use the money in the next few months, what happens between now and a few years from now really makes no difference at all. You wouldn't panic if the price of an iPhone were reduced to $500. Even if you already own the iPhone, what you might do is go out and buy a new one. You wouldn't panic and think, oh my God, I must sell my current iPhone because they're now trading at $500. That reaction simply doesn't occur. That's why I think if you own stocks, Bitcoin, or gold, who cares if the price falls 30% to 50% if you're not planning to use the money anyway? Instead, view it as a Black Friday sale, an opportunity to acquire assets at a discount. It's illogical to wish you had bought at these prices months ago, only to become fearful when they actually drop. Avoid that mindset. That's why I've never understood why some individuals are so fearful of market declines or go to extreme lengths to prevent losing money. Such fluctuations are an inherent part of investing. As long as you're not buying into a speculative asset, history has shown us that long-term patience consistently yields positive outcomes. So, in terms of what I think and my own plan going forward, first, let me just say this. In my almost 10 years of making videos about the stock market, I've observed a consistent pattern. It starts when people are enamored at the prospect of making money, and they succumb to the fear of missing out, FOMO, because they want to maximize their gains. Soon, prices become completely disconnected from fundamental values. Then, an event occurs, and the opposite dynamic takes hold, with fear driving the market more than rational logic. Do not let this define your approach. As no one can predict the future, the only way to ensure you're not left behind is to steadfastly stay the course. Not to mention, price drops like this should be seen as an opportunity. In a peculiar way, the Great Recession provided access to incredible assets that would have otherwise been unattainable. It's how I was able to buy a house in California for $70,000. I never would have been able to have done that otherwise. The same occurred in 2020. I was buying into S&P 500 index funds during the 2020 dip, when it was trading around 2,300, and again in 2022 when markets crashed to 3,600. Similarly, I acquired Bitcoin when it was at 16,000, and also at various other price points like 30,000 and 50,000 during its fluctuations. To me, as long as I don't need the money in the next few years, I keep buying because the specific asset doesn't matter if I don't need the capital immediately. Beyond that, in terms of Kevin Warsh, my personal assessment is that it's highly improbable he won't lower interest rates and generally align with Trump's directives. I believe the market is overreacting. Be realistic for a second. Trump could appoint anyone he wants as the head of the Federal Reserve. He wanted to get rid of Jerome Powell for not lowering interest rates as fast as he would have liked. It's unlikely he would appoint someone who would actively work against his objectives, isn't it? While I don't suggest Kevin Warsh will blindly follow orders, it's highly probable that their objectives and goals are aligned. Otherwise, Trump would not have appointed him. But do keep in mind, as a counter-argument, that in 2007, Kevin Warsh famously stated that everything was fine, that credit risks were non-existent, and banks were doing great, just 1 year before the entire system came crashing down. So, anything can happen, but one thing remains certain. Long term, if you stay the course and continue investing, you will likely be fine. 20 years from now, these short-term fluctuations will likely hold little significance,